Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. And our guest for this week's show is real estate expert Daniel Kwak. Now, Daniel is an entrepreneur, real estate investor, mentor, author of many books, and partner with the Miotti Partners real estate firm. And on a regular basis, you might find him and his brother on YouTube or on stage speaking to empower individuals in the world of real estate investing. Their goal is to put you first and your problems first before all else. And so with that, guys, it's my honor to welcome my guest for today's show, Daniel Kwak. Daniel, how you doing, my friend?
What's going on, Kevin? Thanks for having me on.
Excited to have you. Excited to bring you on the show and just learn a little bit about you. You'll peel back the curtain a little bit, lift up the hood, however you want to say it, and learn a little bit more about you and your business. And so obviously, you guys are somewhat famous. You're YouTube famous, and you guys are out there, speaking to hundreds of thousands of people about real estate investing. But for those that might be listening that don't know of you, Daniel, maybe take a few minutes, and I'll pass it back to you and let you kind of fill in the blanks a little bit. Tell us a little bit more about yourself, your background, and then ultimately how you found your way into this real estate world.
Yeah, well, thanks, man. I'm flattered. I don't know if having 265,000, I think, we're subscribers on YouTube. I don't know if that counts as being a celebrity. That might just you got a fan group a little bit, but you're not really a celebrity. But anyways, so the way I got involved with real estate is very simple. I grew up extremely poor. That's probably an understatement, actually. So my background is our family actually immigrated to the United States when I was 5 years old. And, we lived in one of those apartment complexes where, you flicker the lights on and the cockroaches move from the middle of the room to the outsides of the room, right? They scurry to the walls. That was our background. I loved going to school because it meant I got to eat. There were some nights where, we slept in our car because, we couldn't afford to pay the heating bill. And, a lot of times when you grow up poor, you learn poor. And you learned the mentality and you learned the helplessness and sometimes the victim mindset of what it means to grow up in that environment, which is very unfortunate, but happens a lot in America. So when I was 17, I read an article by Forbes magazine that says that out of the top 1% of people in the world, 76 something percent of those people make their money investing in real estate. And I said, that's what I got to do. Ever since I was a kid, I always wanted to do big things. So my dad was and still is today a preacher. He's a pastor. And every month he would have a guest speaker on. And every single time, it never failed to amaze me the heart that they had for the world, what the impact that they wanted to make, the change in the communities that they wanted to make. But there was a common denominator, and is that they all needed money. And they all needed to raise money. They always had to do fundraisers and all these things. Mm-hmm. And so combining with my story when I was 5 years old with, the stuff I saw throughout my life with these guest speakers that my dad would bring on and the pattern that I've noticed, and then what I read at 17 years old, that kind of inspired me to get into this. And, we all have those moments where it's like, all right, now is the time, I was 18. I had negative $187.65 in my bank account, had a maxed out credit card, found myself looking through the dumpster to find food. And I said, all right, now is the time. Like I have literally nothing to lose. I'm at negative, meaning that if I lost something, that'd be a benefit. I go to zero, right? Zero sounds great right now. So I just went crazy. Like I bought every single course I could on real estate. I bought every single book, listened to every podcast, everything I could get my hands on. And I was just immersed into the world of wanting to learn how to invest in real estate and also finance. So that led me to me being 23 years old. And around that age, I found myself having around 87 rental doors. And then I guess you could say the rest is history. So that's a little bit of my background.
Okay. No, fantastic. And I appreciate that. And just the, the sense of transparency and vulnerability of you sharing your story here. What I'd like to do is kind of fill in the gap there real quick before we move on to the bigger and better things, right? Because that's the foundation. We skipped over, we talked a little bit, you gave me a few ingredients there, but I want the entire menu of ultimately what went into, learning, buying all the books, the courses at 18, because I did the same thing, once I got my little taste of real estate or had even a small understanding of the opportunity that existed, I bought every single book. And, back then it was like cassette tapes or more so CDs. I'm not like that old. I'm not that old.
And all that stuff, right?
CDs, the CDs and things of that nature. I bought as much as I could, went to boot camps when they were around and tried to get to know the people in the, around me in the local marketplace that were doing what I, had hopefully would do one day. And so So from from that initial learning stage to acquiring 87 doors by the age of 23. I mean, that's a pretty monumental feat. So tell us how you did that.
Yeah. I was actually kind of just hoping to end the podcast right there and, kind of just, all right, thanks everyone. See, no, but that's a great question. So I remember when I was in high school, I used to cheat a lot. And I was always super confused because my logic was, well, if I could just ask my classmates for the answer, isn't it the same thing as me looking in the book and just getting it from the author? It's the same information. So one of the things I did when I started learning real estate was, as much as I was reading and listening to podcasts and listening to the courses that I purchased, there was one property manager and there was one project manager who was on the construction side who I shadowed for years. And specifically the property manager, I actually worked for him for free for about 2 years.
Mm-hmm.
And I've gotten more out of those 2 years than probably any book, any podcast, any program I've purchased. Because I actually got to be in it, right? And I actually got to learn and see and whatnot. And, even for people today, for those of you that are kind of hoping to transition from residential to commercial, in my opinion, the best way to do that is, find the one thing that every commercial real estate investor wants, needs, desires, and just be really good at that one thing and use it as leverage to partner with people,
Mm-hmm.
and gain experience that way, because sometimes the biggest drawback for individuals wanting to learn how to invest in real estate or start in real estate is investors and clients, tell them, hey, what have you done your first deal yet? Do you have a track record? So that's one of the things that I did to kind of mitigate that risk. Cause, at the end of the day, I was 23 years old, 22, 21 years old. I knew that I was, still wet behind the ears, right? Fresh in this world, didn't have a whole lot of experience. So something I got really good at ever since I was 19 was networking. And I translated that networking towards recruiting accredited investors. And so what I did was a bit extreme, but I always say you got to go hard or you go home, right? So there was about 2 or 3 real estate investing clubs and events that I was a part of on a weekly basis.
Mm-hmm.
And total, I probably saw maybe 500 to 600 people. And what I did is I got a notepad out, and this was before I even actually even had a smartphone. But I got a notepad out and I asked hundreds of people, in my estimation, probably 300 to 400 people, hey, what's the biggest problem you have in your real estate business right now? And about 60 to 70% of people said, well, I need capital to do deals. But eventually 5 to 10% of those people said, well, Daniel, I'm an orthopedic surgeon. I make $650,000 a year. And my CPA is currently telling me I need to get involved with some real estate for tax reasons. And I've got about 2 million sitting on the sidelines. That's my problem. And so I was very book smart at the time. This is when I was like 21, 22 years old. I've been learning obsessively real estate for the last 2, 3 years at this point. So I was really book smart. I knew and I understood what made a good deal, right? I knew how to underwrite and do all these things. So my service I gave to them for free, might I add, was I would announce to the world that I have a group of investors that I'm talking with. And everybody would send me their deals. I was getting 15, 20 emails a week about, hey, Daniel, what about this deal? What about that deal? And my job and the service I offered was, what if I vetted these deals for you guys, for the investors? And so I vetted them, ran the numbers. It was like Shark Tank, right? I would ask questions and drill down and whatnot, which was really good practice for me. And I started connecting the GPs and the LPs together.
Hmm.
And mind you, not expecting anything in return. I was just being a nice guy. I was just giving without expecting anything in return. And, one day, guy gave me a call. He goes like, hey, I really appreciate you hooking me up with Mark. Do you want 20% of the deal? So for me, initially, that's how I got really good at raising capital. That's how I got kind of connected and got involved with my very first deal, was by partnering with somebody who was more experienced and then networking like crazy and just simply asking, what's the biggest hurdle you have in your
Yeah.
business?
I
And a
love
good
that.
chunk of those people said that they had capital on the sidelines. And by the way, that's a huge problem today. That's a bigger problem today than it was 5 years ago when I did this.
Yeah, I mean, learn how to solve problems, and you will become wealthy, right? I mean, that's it's simply put. And so I want to back up, and there was 2 years where you basically provided your services for free. I think you said in property management. It's
Yeah.
that's very very similar to my own story. When I
Mm,
when I got in real estate, I was 19. Real estate, I always joke that real estate kind of found me, and but ultimately the gentleman that introduced me to real estate was many years older than I. He was already a successful investor, and but he was about 25 years older. And so once I realized I wanted to do what he was doing, um, I knew that he was already successful. So what am I going to be able to offer him, in order for him, in exchange for his time, right, to teach me, right? And so what I identified as one of his big weaknesses was technology. And so I watched him fumble through putting a PowerPoint presentation together one day for one of his investors, that they used to fund his projects, and it literally took him 3 days to do what I knew I could probably do in like an hour or two. And I wasn't even good at PowerPoint. I just knew that I could go look up, whatever I need to do on. I can't remember if YouTube was around back then, but bottom line is,
yeah.
I think they used to have. In fact, I remember back in the day, Microsoft Office. Now I'm really dating myself. Microsoft Office had like this little guy that it was like the help screen. It would
The
literally help guys.
paperclip.
Yeah, the paperclip dude.
Oh yeah,
But
yeah. I see
anyway,
you're trying to do this. How can I help? Yeah.
yeah, yeah.
Good stuff.
Yeah, yeah. In any event, that was the initial value I offered him, just to really get his attention, and I worked for free for about a year and a half, and just
Yeah.
did literally anything he needed out in the field. Dropping off leases, picking up leases, meeting with contractors, literally getting coffee. I don't care what it was. I did whatever I needed to do in between going to class and working, at a bar, tending bar in the evening time, right, and on the weekends. And so my friends thought I was crazy, but I knew that I knew that the value would pay in the long term, right? That I would be able to just through being around him osmosis, I'd be able to gain a lot of knowledge from him to be able to do my own deals, which I ultimately did. So anyway, it sounds very akin to your own story
Yeah.
about basically giving your services and your time in exchange for lessons that would have taken you probably decades to learn, that ultimately you accelerated into a 2 year frame of
Yeah,
time.
and that's where I really learned to think like an actual investor, because I think a lot of individuals who, I mean, you see a lot of these big names nowadays, with people that are my age, right? Guys that are in their late 20s, early 30s, and they're doing really really well in the world of real estate. Some of them are big YouTubers. There's a couple of TikTok guys that I'm like watching. And it's interesting because my mentor and I will kind of just sit down, and my mentor will go, "Yeah, these guys have never experienced the crash. They don't know what it's like. They think that times are really good. They think they're really smart and they're crushing it, but wait, just wait." So he was, at the time I was working for him, he had been in real estate for 40 plus years.
Hmm.
And so he would tell me just every day, all day, just stories about what happened in 81, what happened in 89 and 93 and 96 and '04, right? Like just over and over again. And what it really did for me is it taught me to think in 10-year cycles, 12-year cycles, not just 30-day cash flow. I think for me, that's kind of like my litmus test for what differentiates an amateur investor from a well sophisticated veteran investor. Is, do they think in 30-day cash flow cycles, or do they think in 10, 20-year market cycles?
Hmm.
For me, that's the litmus test. But yeah, to your point, man, I worked for free. It was awesome. I had fun.
Yeah, no, me too. Me too. So fast forward, I know that at some point in time along the way, you ventured into the multifamily world, and I know that before we started the interview here, you'd made a mention that you've pivoted a little bit over the, I don't know what period of time, but you've pivoted recently, and really aren't putting the focus on multifamily at present time, only because of just the massive cap rate compression and just overall market uncertainty and overall competition for deals. I mean, there's a number of factors there, and so maybe speak to that a little bit, the pivot, and then ultimately what you guys decided to pivot to.
Yeah. Oh, but it all depends on who you listen to, right? Because you listen. There's a YouTube channel that I really like. The guy name is his name is Nick. The channel called Venture Consulting, and he puts out a lot of really good stuff on the housing market. But he's very I don't want to say doom and gloom, right? Because he has a lot of statistics to back it up. But on the other hand, you have like my friend Jason Hartman, who's a really smart guy and who's a great economist, brilliant mind. I've been on his show. He's been on my YouTube channel a couple of times, and he's kind of saying the opposite of what Nick from Reventure is saying. So it all kind of depends on who you listen to. But of course, at the end of the day, we all say that real estate is local. It's all about, markets change, but people don't, is one of the things I always tell even my students, my coaching clients. So even, with multifamily, I'm strictly doing multifamily in the Midwest, because a lot of the markets in the Midwest, especially, my home state of Illinois and where I live in the greater Chicagoland area with certain suburbs, they're much more of a linear market than a cyclical market.
Mm-hmm.
And, a lot of the income, the wages, the growth, the employers that are around that support our tenant pool are very strong, and they're sustainable. And there's certain markets where, rents haven't shot up the last 3-4 years like they have the rest of the country. So, that tells me a lot of really good positive things. And from then on, like you and I were talking about, it's all about how you structure the financing, right, and the debt. So there are a couple of parameters and boundaries that I'm following with structuring financing that, I'm being really, really weary of. So, I mean, one thing is I'm staying away from short-term balloons with institutions. That's something that I'm really staying away from. Staying very close, if I can, to buying a lot of things seller financing, especially if I can get a lower rate than what the bank would offer me. Fixed for long-term, no balloon, no refinancing for, especially the next 5-10 years. And then the cash flow is pretty sustainable the next 30, 60, 90 days. And, I know I've got something, I know that's something that I feel pretty good about.
Have you had success with finding sellers that have wanted to carry carry debt on the property as of recent? And the reason why I asked that question is, we probably backing up about 5 years ago, we've been buying manufactured housing communities for now a decade, and for the first 5 years, I would say that 75% of the deals that we did were owner carry. It was almost commonplace. But there wasn't as much capital flying around. Manufactured housing wasn't as desirable of an asset class. It really hadn't been, put out into the masses to where institutions are now trying to pour billions and billions of dollars into it. That didn't exist then. And so it was just a much more under the radar asset class. A lot of banks didn't even really understand the asset class. And so, it was very challenging to even give it a traditional loan. You had to work pretty hard to do that. And so it was fairly commonplace that we would find owners that would just carry notes for us. And, but then, year 6, it seemed that it completely changed. The word got out about manufactured housing. Banks better understood the asset class. We were much further along with the recovery, and the majority of markets across the country that had felt pain now were doing great economically. And so literally the last 5 years, I'm trying to think, maybe one or two of the 20 plus deals that we've acquired have been owner financed. I'm trying to think of which one was, but I'm just picking a random number out of the sky, like maybe one or two. So a very, very small percentage,
Yeah.
versus that of what it was like those first 5 years. And so I guess back to the original question of, have you been successful in actually finding sellers, probably majority older sellers that that don't have debt on the property, that are open minded about carrying financing on the property?
Yeah. And, one of the things I always tell people is, the best deals are never found, they're created,
Mhm.
so, I still have sellers today who will agree to do seller financing.
Okay.
But, yeah. So, but, I always say that at the end of the day, it's all sales, right? So if you're talking about like a conversion ratio in sales, a lot of times, you don't need to be better at sales. Sometimes you just need better marketing. So, one of the things that I did, especially, even if it was just 3-4 years ago, and in many ways I still do this today, is I kind of just reverse engineered how I could find these people, right? So I first started out by saying, okay, and mind you, when I first started out my career, there was I couldn't go to the bank. Seller financing was actually my only
Yeah.
option because, my DTI was horrible. I had no credit, and it was just pretty much impossible. I actually got laughed at by a commercial lender. I still remember the day. Like I told him all my stats and what I wanted to do, and he's like, nice. And I was like, no, I'm serious. And he's like, yeah, me too. Right. One of those things. Um, so I wrote a list for about 2 weeks on all the benefits of seller financing for the seller. And I actually still encourage people to do this today, right? Like think about the benefits of seller financing for sellers today in today's market, which I'm pretty sure you can still find some, right?
Yeah.
No matter what.
Absolutely. If they're
So
not looking to exchange into another property and they're worried about capital gains, I mean, it's
that's
huge.
exactly
It's
right.
huge, and they still want to, they want to maintain basically what becomes an annuity. I mean, the benefits are huge. But
Yeah, no,
anyway,
that's exactly right. And there's so many different ways. And one of the things I love about seller financing is the flexibility that it gives the both parties as the deal, right? For buyers and sellers, there's so many addendums you can add to a contract for deed agreement that makes the pot a little sweeter, right? As opposed to if you have a financing middleman, then it restricts a lot of the things that you can do in the deal that make it really appealing for both sides. So what I did back in the day and what I still even do today that still works is I wrote down all the benefits of seller financing, and I simply asked myself who benefits the most out of these things. And back then it was older landlords, right? And then I started asking myself, well, what are things that I can do to find older landlords? And one of the things I tell my coaching clients, my students, and just people all the time is, if you want to get really good at finding deals, get good at finding people. You should never look to find properties. We should always look to find people. And same thing with investors. You never look to find capital, always look to find people. If you can do that, a lot of these things will just come to you. And I'm a big believer in that. And even our campaigns on finding properties, finding deals, we don't do the things that everybody else does. We don't do the direct mail campaigns. We don't do the eviction court. We don't do those things, right? We do different things to find specifically people, not properties. So what I did is I started doing a little survey, and this sounds bad, but I started asking people in my network who are landlords who are in their 60s and 70s and sometimes even 80s. And I asked them, how do you market your property? Like, how do you, like, what do you do? Like, walk me through the week to week, the month to month. Like, like, what do you, like, who do you know? Who do you talk to? Do you talk to property managers the most, bankers, attorneys? Who's in your network?
You mean market it for sale or market it for lease?
For lease.
Okay.
Sorry, I should have been more clear. Mm-hmm. So what do you do? And the top 3 things I got was newspaper ads, for rent signs, like in the front of the actual building, like the for rent signs. And number 3, building relationships with property managers and people in their network that they've known for 35 plus years, right? 30, 25 plus years. So one of the things I started doing every single week was on, Saturday morning, 3-4 hours, like clockwork. I would drive around certain neighborhoods I really liked, that the research and the market study that I'd done independently supported. I would drive around and call for rent signs, and I would simply see the sign. I take a picture. I make the call right then and there. Considering that it was Saturday morning, 9 times out of 10, you saw the actual landlord on the premise working on something. I would strike up a conversation, but if not, I would literally pick up the phone. I'd ring, right? They pick it up. I say, they say, who is this? I say, hi, my name is Daniel, a local real estate entrepreneur. I saw your sign, was wondering, see if you had any interest in, perhaps selling the property. And I later worked with a psychologist actually to perfect that script. And they said, you should ask a no-oriented question instead of a yes-oriented question. Mm-hmm. Instead of saying like, hey, would you be interested in selling? You should ask, would you be opposed to selling your property, or would you be opposed to having a conversation around selling your property? And even just that change, right? Like those 2 changes right there skyrocketed my, mm-hmm. The conversion ratio to where I can actually sit down with these guys. And so that's what I did every week, like clockwork. 3-4 hours, I drive around calling for rent signs. I pick up every newspaper I can, and see if there was any for rent ads. And then, I would spend a good amount of time going to networking events and going to different, asking around, do anything that I possibly could to get in touch with these, senior commercial lenders who've been part of their bank for 35, 25 plus years. And same thing with property managers. And sure enough, I got a lot of these, landlords who are in their 60s and 70s. And, and maybe it's like, my wife always tells me I have a very natural charm to myself, especially if I try. And, a lot of these people are like, you remind me of my grandson. And, like, oh, are you single? I got a granddaughter who's around your age and all this stuff. And I absolutely loved it. And I loved it for me personally because I got to hear all their stories. Yeah. Like, tell me the story about this deal. How'd you find it? Like, what are some of the biggest? And I learned that sometimes with just those basic conversations, I got access to pieces of information about that property that no broker could ever tell me. No offering memorandum could ever tell me, that no market study or feasibility study that you pay $20,000 for, right? Like, I got to learn all these things just by, sitting down with them and just talking to them like a friend, Yeah. And it was good because it promoted win-win scenarios, and the seller financing actually became their idea, not my idea. Because, you get to learn what are the real problems. And, I always tell people when you quote unquote negotiate, right, you got to put on your detective hat, right? Your job at the end of the day is to gather as much information as you possibly can.
Hmm.
And you do, and different people do it in different ways, but I did it in a way where it was very relational, just because that's who I am at the end of the day. I love people. I love connecting others, and I love just seeing people win, so, we would sit for hours, just hours and hours, 2, 3 hours, just sharing stories, laughing. But at the same time, me gathering a lot of information. And, before you know it, by the end of it, they're like, I think this owner financing thing starting to grow on me a little bit. I can see your point. Um, and so that's how I did it. If I'm being honest, right?
Yeah, no, that's fantastic. So no, I've had a lot of those conversations myself. So it's
Yeah.
definitely a very memorable experience, and I felt like I helped a lot of sellers. You really create the best solution for them in selling their property, and obviously it's a win on both party sides. So owner financing is an absolutely beautiful thing if you can get a seller to agree to it, and if you can structure the terms again in a win-win manner. I've had many situations where we've went and got had an owner willing to finance a property, and ultimately went and got a bank loan because it was going to be a win, win on their side but lose on our side transaction. And so in any event, I want to be conscious of the time here. We've got about 15 minutes before we need to wrap this thing up, and so I definitely wanted to hit on another part of the conversation that we had chatted about a little bit before we went live here in the interview, and that was related to there's some counties, very particular, not just counties but markets in Florida that you guys are very bullish on, where you've been acquiring raw land, looking to assemble raw land and acquire it in mass scale. And so maybe speak to that side of your business a little bit. What particular county or counties in Florida, and why those counties versus the many others. I don't know how many counties are here in Florida, but there's obviously Florida's a hot market in general, but there's very specific markets that you guys are incredibly bullish on.
Yeah, yeah. So, our firm, Miotti Partners Capital, that's where we operate, is Brevard County, Florida. So that's the county that we believe that
Hmm.
we're very bullish on. And I'm bullish not because of how high it could go up in valuation, but because of the sustainability that it has over the next 2, 3, 5 years, right? I think we could all agree that probably within the next 3 to 5 years, there's going to be some serious things hitting the fan. There's going to be some downturns. People are going to unfortunately have some tough times financially. Not that we ever wish that, and we don't ever want that to happen, but it's just life. It's just the way it is.
I think I
Um,
think it's already starting to happen as of this morning, and we're recording
I
this
know.
on June 14th. The
Yeah,
10-year Treasury is the highest it's been in 11 years. I think it's
yeah.
3.47 or something like that. So, which is
Oh,
absolutely
absolutely, right. I
crazy.
mean, all across the board, right? I mean, it's unreal. So, but anyway, Brevard County. So it's something that I've been eyeing for the last 5 years, and something it's a county that I've been very bullish on, mainly because of the space industry, the private space industry. That's where SpaceX does majority of their launches. You have companies like Terrain Orbital and Boeing, Lockheed Martin. And my partner Kevin, who's in this with me, he actually moved to Brevard County. He used to live in Orlando and picked up his whole family and moved to Vieira. Um, and one of the things that he says all the time is, if you look at the growth of a city like Detroit between 1900 and 1930, it wasn't GM or Ford and Chrysler that built Detroit. It was actually the ancillary companies that built the steering wheels and made the tires and made the rubber and made all these different parts, because that's what drove so many different businesses and population and commerce and from commerce culture, right? And I believe the same thing is happening in Brevard County. You look at the next 10, 15, 20, 30, I mean, heck, the next 100 years, humans becoming an interplanetary species is well in the cards. And Brevard County has a very, very big part in that, geographically speaking. And they know it, and people know it, So that's a market that we're very, very bullish on, and mainly because a lot of the big boys that we don't want to be competing with, we find them being in the other part of
Yeah.
Florida, and kind of more towards the Naples and Tampa where you're at,
Yep.
Kevin. And then of course the Arizonas, the Texases, the Carolinas, the Tennessees, a lot of the bigger guys, that's where they're playing.
And so is it simply just a land grab at this point in time? Is that what the business model is?
Yeah, so it's both income and growth. So
Okay.
thankfully, my partner Kevin Tuttle, and that's close to you, Kevin. His background is in finance and hedge fund investing. So he used to be one of the top PIM managers at Wachovia before they got bought out by Wells Fargo. And based on even that sentence alone, He's got a little bit more gray hair than I do, right? So he's been in the game for about 25, 30 plus years. And he was actually, and I love talking about him because he was one of the few guys that predicted the '08 crash and also the dot-com bubble.
Mhm.
He was actually saying back in 2004 that, mortgage-backed securities are going to, that pile of cards is going to fold. And so he's a really, really smart guy. And, he's very, very bullish on Brevard County. But that was his background. So it's income and growth. So the growth aspect comes from the land.
Gotcha.
And then the income comes from the bridge financing, the debt fund, the debt portion of our fund.
Got it. No, fantastic. I appreciate that. And one question I always like to ask our guests on the show before we wrap things up here. And you've been doing this now. How old are you? You're still really young. And you look. I mean,
Yeah, I'm 28.
okay. So you've been at this now for for 8 years or so, and you've done many deals along the way of all different sizes and scope, and each deal has its own challenges and hair associated with it, some more than others. And there's always that one that kind of sticks in the back of your mind, the one that gave you the gray hairs. You don't have them yet, but maybe there'll be a little bit more. There'll be premature gray hairs because of this one deal, right? The deal that you lost sleep over, the deal that just
Yeah.
added more undue stress to your life than what you felt was fair at that time, right? And so what's that one deal? What comes to mind when I say that? What's the deal? What were the challenges associated with it? And ultimately, how'd you overcome them?
Yeah. So it wasn't the greatest resolution, but it was one of our first deals and we were very young and dumb. And that's kind of the youthfulness, right? So we bought a 3-unit deal in Cook County, which I will never do ever again. So Chicago, I would argue, is probably one of the hardest cities to do real estate in.
Because it's so tenant friendly, correct? Is that why?
Absolutely. I mean, they have so much power. The tenants do. I mean, it's unreal. And not only that, but the municipality and just they just ring you. They nickel and dime the landlords and make it really hard. I mean, I have clients, right, and even myself, where you look to pass something like a permit or something with the Cook County, and 90 days will go by and nothing gets done. 6 months will go by and nothing gets done. And like after a year, you'll finally get something. And I mean, it's just ridiculous, So that was one problem. And then there was the same building, the same 3-unit. We didn't know this, but the tenant of our middle unit was running a very friendly massage parlor. Let's put it that way. And, we noticed that when we were checking out the unit, we were just doing some inspection. There was a lot of cash laying around. There was a lot of hints that would allude to her running an illegal operation out of her unit. And it just so happened that one of her quote unquote clients happened to be like a top 5 realtor in the city of Chicago and would literally just feed her information on how to make our life a living hell. So it was a cash for keys scenario. And then after like 3 months, we decided to sell the building. We actually sold it seller financing and somehow made money on it. But man, we got really, really lucky. I think if it was any other year, we would have been doomed.
Yeah, that's scary. So, Cook County, just let's get some more context there, because you're not when you say that you're based in the Chicagoland area. Chicago is huge. And so, Cook County is basically the city of Chicago. Is that correct?
Correct.
It's the
Yeah.
city.
Yeah.
Okay.
It's about the city plus like 15, 20 minutes out.
Okay. And then you predominantly focus in which county? You're based in which county? It's a
Yeah.
neighboring
So
county.
yeah, we do neighboring counties. So like the DuPage, the Canes, the Wills, the McHenrys. Like that's
Yeah.
yeah, all the counties except Cook. And
And
that's
you
where
have
we're focused on.
and you have found that as far as tenant landlord friendliness, or yeah, I guess landlord friendliness, when it comes to evictions and just regulatory issues surrounding owning rental property, you found that pretty much any other county is fairly landlord friendly with the exception of Cook. I mean, is that an accurate statement?
Yeah, they're significantly more fair than Cook.
Okay.
Absolutely.
Did you have
Yeah.
any challenges, due to COVID? I mean, were there? I know Cook is, again. Let's just that's kind of its own world. And so, did you run into any challenges with regards to, kind of unruly tenants or just those that were working the system to where you couldn't get them out for, for
Sure.
a couple years? I mean, really during the years of COVID,
Yeah.
which has lasted over two
So
years.
my portfolio makeup was a good amount of single family homes, a lot of like a lot of, some 2 units, 3 units, and 4 units. And, but all my bigger apartment buildings, like the, 20 to 30, 40 unit buildings, I actually sold on seller financing. My last apartment I sold, I think it was early March of 2020, right before all the lockdowns started happening.
Okay.
So I sold them for a different reason, right? Because I thought the market was going to crash in 2020. So I sold it, very early 2020 at the latest, right? But I bought them on seller financing. So, I'm not sure how those projects. I think they did okay. I think they were still doing. I think they had like an 87% collection rate or something like that.
Hmm.
So I think they still did fine.
They
To
paid the
answer your
note.
question.
That's the important part. They
Yeah,
pay,
yeah. So I'm still getting paid.
yeah, that's the
Pretty
important
sweet.
part.
Because what we did is we actually did a value add. We actually bought distressed properties in 2017. We bought a lot of them, and then we bought the ones that were $100, $200 below market rent. We bought one 36-unit building on average, where each unit was $300 below market rent.
Hmm.
And I actually cashed out an evaluation of, I think, about 2.5 when we bought it for 1.5 3 years ago. I cashed out an evaluation of 2.5 right before COVID happened. So,
Hmm.
um, I mean, there's parts where, like, I had a interview with a guy who's pretty well known, and he's like, "Hey man, I bet you wish you would have kept them, right? Because rent skyrocketed." And maybe I did, maybe I didn't, but just I know I did it. I know I exited at the right time, and I felt really good about it. So
It's really hard to time the market, and it's never a bad thing to take some chips off the table. So
yeah,
I learned that after 2008. So I stick with that. I never look back after we decide to exit out of a property. I might not be so happy about that we're exiting out of something. We just had one recently that we sold, and I was kind of reluctant to sell it. And literally, it was January of this year. We carried it over to the new year because of tax reasons. And we sold it, and then literally within a few months, and the guy that bought it from us has got a value add plan as far as infilling a bunch of vacant lots. It's a mobile home park, and so time will tell what that looks like, because his plan is going to take him 2.5 years to be able to get it to where he can actually tie permanent debt in place. And he's got a 3-year balloon tied to his existing note. So I wish him the best, but bottom line is the rates went up literally 100 basis points from
yeah,
literally shortly after us selling it, which would have equated to like $1 million probably discount on the sales price if we would have held
oh
it longer. So maybe I just wouldn't have sold it at that point, right? But like anyway, I feel like not that I tried to time the market, but on that particular deal, we seemed to time it quite well. And so
yeah,
it worked out. And again, no regrets. And it was cash flowing just fine. And really, we would have been fine holding it for the next 10 years. But,
yeah.
again, no regrets. We move on and buy more deals. So with that being said, Daniel, I really appreciate you coming to the show. For those that want to learn more about you and what you got going on, where's the best place to track you down?
Yeah. So you guys can all just go to the place where I give stuff away for free. So we actually give away a free real estate course. There's actually a free capital raising course in there. I mean, we try to give as much out as we possibly can. I actually have a free class on how to pitch and find owner financing. So
Mhm.
if you want to learn how to do that, it's a 3-hour class on how I personally negotiate it. So you guys can just go to thekwakbrothers.com. There's a tab where it says free stuff, and all our stuff is there. So, I mean, we have, I think, nearly 100 hours worth of free material that people can go check out.
So it's thekwakbrothers.com.
Yes, correct.
Alrighty.
Thekwakbrothers.com.
Okay, fantastic. Well, Daniel, thanks again for joining us. This has been a lot of fun.
Yeah, and by the way, I usually don't do this, but I actually had a lot of fun with this podcast episode, and I love how deep we got. If people want to just reach out to me, just say hi directly. It's just Daniel@thekwakbrothers.com. That's actually my primary email. So again, if people just want to say hi and they say, hey,
Okay.
you could have said this better, or like, or give me constructive criticism. There you go.
Yeah.
Yeah,
Yeah.
feel free to just email me there.
Fantastic. Awesome, Daniel. Well, it's been a pleasure having you, my friend.
Thank you so much, Kevin.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.